I'm going to go ahead and introduce our next speaker. His name is Chuck Hughes. Now, after graduating from college, Chuck Hughes entered the U.S. Air Force pilot training program. He served 6 years on active duty as a pilot and 6 years in the Air Force Reserves. When Chuck completed his Air Force active duty tour, he got his dream job as an airline pilot flying a major U.S. airline. Chuck knew the airline industry was financially unstable with frequent bankruptcies, downsizings, layoffs, and pension terminations. He also decided to develop a backup income source that he could depend on in the event he was laid off or his airline went bankrupt. On the days he read everything he could find on trading stocks and options and attended trading seminars, Chuck attended a Larry Williams trading seminar and learned how to trade stock indexes using systems. With a young daughter and a son on the way and a large mortgage payment, Chuck had to start small with a $4,600 trading account. But his tax returns show that he made $460,164 in profits in just his first 2 years of trading. Chuck has written numerous books, including the Guaranteed Real Income Program, the Fail-Safe Financial Program, Market Volatility Profit Secrets, the Wealth Building Formula, the Global Power Trend System, the Wealth Creation Alliance Course, Stock Market Magic, the Wealth Building Business Course, Sure Thing Profit Secrets, and Weekly Option Winners and Ultra Safe Money Strategies. Without further ado, I'm going to go ahead and let Mark take over the mic.
Good afternoon, everybody. This is Chuck Hughes. I'm excited to be here today. I have a very simple strategy to show you today. It takes about 10 minutes a week to implement. And I've been trading this strategy for many decades. And the nice thing about this strategy is it works well in any type of market, especially when we have volatile, non-trending markets like we've had this year. So very simple, easy to manage strategy, like I say, 10 minutes a week, and it's a very low-risk strategy. So if you want something that you only takes a little bit of time each week to implement, you don't have to watch the markets during the week, this might be something you want to do. So today we're going to take a look at generating weekly cash income from the sale of weekly option premiums. And I'm going to show you my brokerage account statements that show how I generated over 100% cash-on-cash return over the past year with very low risk. And as I mentioned, this strategy only takes about 10 minutes a week to implement. And I'd be glad to answer any questions at the end of the presentation. So my brokerage account statements I'll show that I generated over $750,000 in cash income from selling these weekly covered calls. Let's just take a look at the general market environment this year. Here's a snapshot of the daily price movement of the S&P 500 index, and the red bars, vertical bars, are down days on the S&P. The black bars are up days in the S&P, and you can see the S&P has been pretty volatile. We've had big down moves, big up moves, down moves, up moves, down moves. So and it's virtually unchanged from where it opened at the beginning of the year. So we're in that type of market mode where the market's not really trending well, and we have a lot of daily price volatility. So with this weekly covered call strategy, this can still generate over 100% cash-on-cash return even in this type of market environment. And we've seen these types of markets a lot lately. Here's a snapshot from 2012. Again, this is daily price movement of the S&P. You can see a lot of price volatility, and the index was actually unchanged over this time period. Here's 2011. In 2011, we had 68 days during which the S&P closed up or down more than 2%. So a lot of price volatility in 2011. And here's another snapshot. This is 2010. Over this period, the S&P only changed 2 points. Here's an interesting statistic. In 2011, the S&P started the year at 1257 and it ended the year at 1257. So it was literally unchanged for the year, but you can see a lot of price volatility here. So if you're taking directional trades in this kind of market, you can easily get stopped out with these volatile price swings. So with this covered call strategy, this is ideal for volatile price swings because the volatility, of course, increases the premiums that you receive every week from selling these weekly covered calls. So it's a good strategy to use in this type of environment, and it looks like this year is going to turn out very similar to 2010, 2011, 2012. Okay, so this is a very simple strategy to implement. If you want to try this strategy, you simply buy 100 shares of a stock or an ETF, and then you sell a weekly call option against your 100 shares of stock. And not all stocks or ETFs trade weekly options, but there's quite a few now that trade weekly options. And then what I like to do is if I own a stock or an ETF, I like to just keep that in my account each week, and I'll close out the expiring option on Thursday or Friday, and then I'll sell to open the new option. So once a week I close out the expiring option and then sell to open the new option. That way I get to keep the stock or the ETF in my account. So this rollover only takes about 10 minutes a week to do. So weekly options, if you're not familiar with weekly options, they start trading on Thursday and then they expire the following Friday, and they have a life of 6 trading days. And this gives us 52 opportunities each year to sell this option premium. And I've been doing this week in and week out since 2010 when they started trading these weekly options. Prior to 2010, I was using this strategy with monthly options, but there's a lot more opportunities to sell premium, obviously, if you can do it every week. So just a general overview of selling option premium. When you sell option premium, cash is immediately credited to your brokerage account. And of course, with the weekly options, we can sell this premium each week, and as soon as we sell the premium, then cash goes into our brokerage account. So if you sell an option that has 4 points of premium, then $400 in cash is credited to your brokerage account when you sell that option. And of course, this cash reduces the cost basis of your stock and reduces the overall risk of the trade. And selling these weekly options allows you to compound your returns very quickly. And I do this. What I'll do is when I'm collecting all this cash into my account, that really starts to build up. And what I do is as soon as I have enough money, I'll trade an additional weekly covered call. And that way I can compound my returns and increase my positions over time as I'm collecting this cash income each week. So with these weekly covered calls, as I mentioned, you can collect 100% cash-on-cash return regardless of the price movement of the underlying stock. So in other words, once that cash goes into your brokerage account, you get to keep that no matter what the underlying stock or ETF does. And for example, if you invest $4,000 in a weekly covered call, you could receive up to $4,000 in cash income over the course of the year, no matter what the underlying stock does. So that's a pretty good return for such a low-risk strategy. And as I mentioned, these weekly covered calls have been very profitable in every type of market condition. And there's less risk with this strategy than there is with owning stocks or ETFs. And just to give you an idea of the covered call strategy in general, in 2009, I was trading covered calls in the World Trading Competition, and I had a 122% annual return that year. So I won the contest with that return. I started out with a $100,000 starting balance, and then I had $122,000 in profit. So this is a real money contest, and I just wanted to give you an idea of the return potential for covered calls in general. Now, back in 2009, they weren't trading the weekly covered calls because they didn't start till 2010, but I was trading the monthly covered calls, and I would roll over my profits each month, and that allowed me to compound my returns, and I got a 122% annual return with this strategy. And I'm actually in the world competition this year, and so far this year I have 120% return with this strategy. So let's look at some actual trade examples. In my brokerage account, I have 800 shares of the TNA ETF, and this is a leveraged small cap ETF. So I have these 800 shares in my account. This is in one of my smaller retirement accounts. So I just hold those 800 shares in my account, and each week I'll close out the expiring weekly call, and then I'll sell to open the new call. So I like to just keep the stock in my account or the ETF. It keeps things simple, and I simply roll over the weekly option each week. And here's an example. This is an actual order that I entered to roll over the expiring weekly call and sell to open the new call. And at the time, TNA was trading at 54.27. So I put an option spread order in to buy to close. In this example, it was the November 23rd weekly call option. That was the 52 strike weekly call. And then I sold to open the November 30th weekly call, and that was the 54.5 strike. So TNA at the time was trading at 54.27, and I sold the 54.5 call option, which was the at-the-money option at the time. So I got filled on this order at 142. So I collected for each 100 shares of TNA, I collected $142. And this netted out after commissions that week to be $1,125. So I received $1,125 in cash income from selling these 8 54.5 strike weekly calls. Now, if you divide $142 by the cost, if you were to enter this trade that day, of course I already owned the stock in my account, so I just kept it. But if you were to purchase 100 shares at the time, it would have cost you $5,427. So if you divide this weekly premium that you're receiving of $142 by 54.27, which would have been your initial investment, that turns out to be a 2.6% return on this $5,400 investment. So 2.6% doesn't sound like a lot, but if you do that every week, that really adds up fast. So if you were to get a similar premium and did that over a 52-week period, you would wind up with 136% annual cash-on-cash return. And I have been able to get a similar premium each week over the past 4 years that I've been doing this. So, and again, I get to keep this $1,125 in cash income regardless of the price movement of the underlying ETF. So over the course of the year, if I was to receive a similar premium each week, $142, some weeks it'll be less, some weeks it'll be more. It'll depend on the price of the underlying ETF. But this just gives you an idea. If you were to collect on average $142 in cash a week on your original investment of $5,427, so 142 times 52, you'd be collecting $7,384 in cash over the course of a year. And if you divide that $73.84 by your initial cost of $5,427, that works out to 136% cash on cash return over the course of a year. So with that kind of cash on cash return, even if TNA declines 20 or even 40%, I still have the potential to realize a good return. So with these weekly calls, a lot can go wrong and you'll still profit. So if you're collecting 136% cash on cash return, the underlying stock or ETF could decline substantially and you could still profit. If you had bad timing on when you entered the trade, you could still profit. There could be volatile price swings in the underlying stock or ETF and you would still profit. So this gives the weekly covered call strategy a huge advantage over stock and option directional trades that require the stock or the ETF to move in the right direction in order for the trade to profit. So unlike directional trades, these weekly spread trades can profit even if the stock goes down. And also, I showed you the price graphs of that S&P and those volatile price swings, and when you have this kind of a covered call trade on, it can help prevent getting stopped out of a trade like you would if you had a directional trade. And when you have those volatile price swings, very easy to get stopped out of a stock or option trade if you have bad timing during those price swings. Now, when I roll over these weekly options each week, and in this example, over the course of a year, I could receive up to $7,300 in cash income. What I'll do is I'll purchase additional covered calls as time goes by, and this allows me to even compound my returns further. So this is a great strategy for volatile markets with very little trend. So I'm going to show you a couple more examples. This was the February 8th weekly call. At the time, TNA was trading at 75.76, and I sold to open the February 76 calls. And here's another example. This was the March 8th weekly covered call at 70 strike, and I sold that at 191. So if you divide the 191 by 78.78, that was a 2.4% cash income that week. This week it was about a 2.5% cash income if you divide the 191 I got by the price of the ETF for the February 8th weekly covered call. So these are just examples, different time frames, but you can see I've been consistently getting about a 2.5% return each week with these weekly covered calls. Here's another example. This was the March 28th 87.5 strike call. Now I sold that at 234. So if you divide that by the price of the stock at the time, that was a 2.66% weekly cash income. And here's the order I used to initiate this 87.5 strike. Here's my fill price down here was $234. So I collected $234 per contract that week. That was the March 28th options. Here's some more examples. What I did is I went into my brokerage account and I just looked at transaction history over different one-week periods just to see what I was collecting that week. And this week, this was back in 2012, this week I collected over $13,000 in cash income. And this transaction report, it lists the option that I sold in this column, and over to the right here it lists the amount of cash that went into my brokerage account after commissions. So you can see that week I was trading the Apple weekly covered calls, financial ETF, NASDAQ 100, Humana, Home Depot. So there's a lot of stocks now that have these weekly calls, and if you simply own 100 shares of that stock, you can sell these calls every week against your stock. So pretty simple strategy, pretty easy to implement. So that week I collected $13,000. Here's another example. This week I collected $16,000. Here's another example. This week I collected $28,000. This week I collected $19,852 in cash income that went into my brokerage account. Here's one more example. This week I sold $14,929 in cash income, and if we were to take this $14,929 and project that out over the course of a year, I could collect up to $776,000 in cash income over a one-year period. And as it turned out, I took a snapshot of my brokerage account transaction reports, which I'll show you, and over the previous year I did collect $751,000 in cash income, and this resulted in more than a 100% cash-on-cash return for the amount that I had invested initially. So collected $751,000, and again, that's cash that went into my retirement account, brokerage account. And what I'm going to do is I'm going to show you the transaction reports during the period that I collected this $751,000 in cash. And again, it lists the option that I sold, and then on the right-hand column, this is the amount of cash that went into my brokerage account. So over the course of a year, these are just all the trades that I took, weekly covered call trades I took, and the total, I have two retirement accounts where I trade these weekly covered calls. In the first account, over that one-year period, I sold a total of $692,000 in cash income, and in retirement account number 2, I sold $59,000. So that comes out to about $751,000 over that one-year period. Now, here's the reason why these weekly options are so lucrative. What I did is I took a snapshot of an Apple option chain, which included the weekly options. In this, when I took the snapshot, it was the March 23rd weekly options. Now, they had 7 days to expiration, and if you sold the at-the-money call at the time, Apple was trading at $5.85. So if you sold the at-the-money call, you would have collected 14 points of premium. But if you sold The monthly option, you would have collected 28 points of premium, 28.30 in premium if you sold the at-the-money call. Now this monthly option, the April monthly option, had 36 days to expiration. So over that 36-day period, I would get to sell 5 of these weekly options at around 14 points, which is a total of about 70 points of premium for selling the weeklies versus 28 points of premium for selling the monthlies. So over the same time period, I would have collected about 70 points versus 28 points. So that's why these weekly options are so rich in premium, and that's why they're so profitable, because you get a lot more premium over the same amount of time that you would for a comparable monthly option. Here's another example. This was for MasterCard. At the time was trading at 457. The at-the-money call would have been the 460. You'd collect about 1190 premium. And if you sold the July options, which expired in 82 days, you'd collect 23 points of premium. So I get to collect 12 of these weekly premiums at 1190, which would come out to about 140 points of premium versus 23 for the monthly option over the same period of time. So that's why these weekly calls are so lucrative. And this is a snapshot of my 2009 trading contest account, and as I mentioned, I placed first that year with an annual return of 122%. So these were monthly covered calls. I just wanted to show you an example of that, and this was an actual snapshot from my contest trading account. And at the time I had 46,000 in closed trade profits and 71,000 in open trade profits. So the covered calls, the monthly covered calls at that time produced 122% return for the year. Here's another snapshot. This is from 2011. I had weekly covered calls in my retirement account. When I took this, I had a $323,000 profit, open trade profit, average return of 54%. That just shows you different time periods that the profits I had on these weekly covered calls. And here's a snapshot from 2012, and in my retirement account number 1, I had $215,000 in profits, and in my retirement account number 2, I had $116,000 in profits. So that just gives you an idea of different time frames and what this strategy has produced. So this is a comparison of what it would take to generate $50,000 of yearly income, what kind of investment it would take. Now, if you invested in half of your money in 1-year CDs and half of your money in 5-year CDs, if you wanted to generate $50,000, and it would take a $6.7 million starting balance to generate that $50,000. So, of course, that's guaranteed, and you'll always get your money back. But you saw that with these weekly covered calls, I had 102% return in 2009, 54%, 36% in 2012, 39% in 2013. So I think it's reasonable to assume with these weekly calls that you could get a 33.3% yearly return. If you could get a return, it would only take $150,000 the $1,000 yearly income. So of course this is not guaranteed, and it's higher risk, but I'll risk rather than invest $6.7 million to generate $50,000. So that concludes my presentation. The advisory service and we trade weekly covered calls, strategy. If you want to get an update on how the strategies you're doing, just log on to weeklyoptionalert.com and click the trades link, and it will tell you how the various weekly option strategies are performing. That concludes my presentation for today. I think I went over a little bit, but I'd be glad to take any questions anybody would have.